Hi dear traders, last trading week was short for American traders, so on Thursday and Friday, during a public holiday in the US, traders from Europe could observe the so-called thin market. Therefore, the main trading activity in the market was going until Thursday. The US dollar index, which demonstrates its value against the basket of 6 major currencies, was fluctuating near the mark of 106 at the end of the week. Before leaving for Thanksgiving Day, traders pushed the US dollar index to its 3-month low in response to the FOMC meeting minutes. A fairly large number of FOMC members agreed that it was necessary to slow down the pace of rate hiking cycle. Apparently, the officials of the regulator are considering the risks of the recession and would like to evaluate the effect that their actions have had on the economy. Amid a weaker US dollar, the euro managed to gain 0.67%. Now traders use the difference in the rhetoric of the two central banks. Unlike the Fed, the ECB continues its aggressive monetary policy in order to curb inflation. Besides, the demand for the euro had increased following the release of the preliminary PMI data in the eurozone. According to estimates, a decline in business activity has slowed down. The British pound also took advantage of the weakening US dollar. In the course of the week, the pound-dollar pair broke above the level of 1.20 and settled firmly there. At the same time, the Bank of England, just like the Fed, is ready to slow down the pace of monetary tightening. Still, traders keep buying the pound as they are encouraged by the new economic policy proposed by Prime Minister Rishi Sunak and Chancellor of Exchequer Jeremy Hunt, who have restored confidence in the UK economy. Meanwhile, the Japanese yen advanced by 0.84% against the US dollar. The Bank of Japan prefers to maintain its ultra-loose monetary policy in order to support the economy of the country. However, the inflation rate in Japan has already reached a 40-year high, and the economy has contracted in the third quarter, even despite all the efforts by the central bank. Hints that the Fed is going to ease the pace of monetary tightening changed the sentiment in the commodities market. Gold is very sensitive to rate hikes, as high interest rates make it less profitable to hold gold. Expectations that the US regulator will raise the rate by 50 instead of 75 basis points this December helped gold return about $1,750 per troy ounce. In the meantime, oil traders seem to be the only ones who could not benefit from a fall in the US dollar. More COVID restrictions in China and news about a price cap on Russian oil approved by the G7 countries put pressure on oil quotes. Over the past week, BRENT lost more than 4% and declined below $84 per barrel. Such a drop in oil prices may influence the decision of the OPEC Plus members who are planning to meet on December 4. These are the trends of the last trading week, and now a new week and new portion of macro data are ahead. Do not miss our daily news reports to be always in touch with the latest events. See you soon.